Ever find yourself puzzled by the fine print in your loan agreement? It's a common predicament. You're not alone if you've ever felt overwhelmed by the jargon and legalese that seem to shroud loan agreements in mystery. But here's the thing. Understanding this fine print is crucial. It's the key to unlocking the true nature of your financial commitments. Let's consider it this way. Imagine entering a labyrinth without a map. That's exactly what you're doing when you sign a loan agreement without completely understanding its terms and conditions. The consequences can be as mild as unexpected charges or as severe as falling into a debt trap. So the question arises, how do we navigate this labyrinth? How do we decode the fine print? That's exactly what we're here to do. Journey with us as we unravel the mysteries hidden in the fine print of your loan agreement. Interest rates, they're more than just a percentage, but what does that really mean? Let's dive into the world of interest rates and decipher the mystery. Interest rates are the cost of borrowing money expressed as a percentage of the loan amount. Think of it as a fee lenders charge for letting you use their cash. But be aware, the higher the rate, the more you'll have to pay back. Now, interest rates are not one size fits all. They come in different types: fixed, variable, and compound. Each has its own distinct implications on your total repayment amount. First, let's talk about fixed interest rates. As the name suggests, a fixed rate remains the same throughout the loan term. Whether the market rates rise or fall, your rate stays consistent. This type of rate provides predictability, making budgeting easier as your repayment amount remains steady. On the other hand, variable interest rates, also known as floating rates, fluctuate over time. They are tied to an index, such as a base rate set by the central bank, and can increase or decrease based on market conditions. While this type of rate can offer lower initial payments, there's also the risk of rates rising in the future. Lastly, we have compound interest. This is interest on interest, calculated on the initial principal and also on the accumulated interest of previous periods. Compound interest can cause your debt to grow at a faster rate, so it's crucial to understand how it works. So how do these rates affect the total repayment amount? Well, with a fixed rate, you know exactly what you'll pay over the loan term. With a variable rate, your total repayment could be less if rates decrease or more if they increase. And with compound interest, the longer you take to repay, the more you'll end up paying. Remember, when choosing a loan, it's not just about the principal amount. The type of interest rate can significantly impact your total repayment and overall financial health. Understanding interest rates can save you from unpleasant surprises down the line. So be sure to take the time to understand the fine print and make well-informed decisions. Did you know, besides interest, there are other sneaky charges hiding in your loan agreement? It's like going to a restaurant and finding out that the price on the menu doesn't include taxes or service charges. Suddenly, your meal costs more than you'd planned. Let's start with processing fees. This is a fee that your lender charges for the service of processing your loan application. It's like paying for a ticket to enter the financial roller coaster. This fee can be anywhere from 0.5% to 3% of the loan amount, depending on the lender. Next up, we have prepayment charges. This is a fee you'd pay if you decide to repay your loan ahead of schedule. It's like being penalized for being too efficient. The lender charges this because they lose out on the interest they would have earned if you had stuck to the repayment schedule. This fee can be up to 2% of the outstanding loan amount. Then there are late payment fees. If you miss a payment or make a late payment, you'll be slapped with a late payment fee. This fee is like a strict school teacher who doesn't tolerate tardiness. The amount varies from lender to lender, but it usually ranges from 2 to 5% of the overdue amount. There are also other charges like legal and technical verification fees, loan statement charges, and loan cancellation charges. Legal and technical verification fees are charged for verifying your documents and the property you're buying, respectively. Loan statement charges are for providing a statement of your loan account, and loan cancellation charges are for, well, canceling your loan. In addition, there might be charges for changing your loan tenure or switching your interest rate type. These are like charges for changing your mind, essentially. All these charges are like little termites, slowly and steadily eating into your finances. They might seem small individually, but collectively, they can significantly increase the cost of your loan. So it's crucial to read and understand the fine print of your loan agreement. Ask questions, seek clarifications, and ensure you know exactly what you're signing up for. Remember, these fees can add up, significantly increasing the cost of your loan. When and how you repay your loan matters, but how can you make sense of the repayment terms? Repayment terms refer to the conditions under which you're expected to pay back your loan. They're essentially the rules of the game, defining when and how much you need to pay, and they can significantly impact your overall loan experience. Let's break it down. First, let's talk about tenure. Tenure is the total time you have to repay your loan. In India, this can range from a few months to as long as 30 years, mainly depending on the type of loan. A longer tenure might seem attractive because it means smaller monthly payments, but remember, the longer the tenure, the more interest you'll end up paying overall. Now let's move on to equated monthly installments, or EMIs. Your EMI is the amount you pay back to the lender every month until the loan is fully repaid. It includes both the principal amount and the interest. The EMI is calculated based on the loan amount, interest rate, and tenure. A higher EMI might mean paying off your loan faster, but it also means a bigger chunk out of your monthly budget. Finally, let's consider the impact of these factors on the total repayment amount. The total repayment amount is the sum of all your EMIs. It's the total money you pay back to the bank, including the principal and the interest. The key thing to remember here is that your repayment terms, your EMI and your tenure, will directly affect this total. A longer tenure and smaller EMIs might make the loan seem more manageable, but they will also increase the total repayment amount due to the accumulated interest. Repayment terms can make or break your loan experience, so choose wisely. What happens if you fail to repay your loan? It's more than just a hit to your credit score. That's right. The consequences of defaulting on a loan are far-reaching and severe. When we talk about default, we mean the failure to repay a loan according to the terms agreed upon in the loan contract. This could be due to several reasons, such as financial hardships, job loss, or perhaps mismanagement of finances. But what happens when you default on your loan? The first consequence is legal action. When you default on a loan, the lender has every right to take legal action against you to recover the debt. This could be a lawsuit or a court proceeding, which can be both stressful and expensive. The second consequence is asset seizure. Depending on the type of loan, the lender might have the right to seize your assets to recover the loan amount. If it's a secured loan, like a mortgage or a car loan, the lender can repossess your home or vehicle. If it's an unsecured loan, they might garnish your wages or levy your bank accounts. The third consequence is the impact on your credit score. A default can significantly drop your credit score, making it harder for you to get loans or credit in the future. It stays on your credit report for 7 years, affecting your financial life for a long period. But it doesn't stop there. The default can also affect your relationships with other lenders, making it difficult for you to get loans from other sources. It can even affect your job prospects, as some employers check credit history before hiring. In a nutshell, defaulting on a loan can lead to a financial downward spiral, affecting your life in ways you might not have imagined. It's like a domino effect, where one financial mistake can lead to a series of unfortunate events. So it's crucial to understand the seriousness of defaulting on a loan. Always ensure that you have a solid plan to repay your loans on time. Defaulting is a serious issue. Prioritize loan repayment to avoid such dire consequences. So, we've decoded the fine print for you. But what does this all mean for your financial health? Well, let's take a moment to reflect. We've journeyed through the often overlooked details of loan agreements, from understanding interest rates and their types, to delving into the hidden fees and charges, and even the nitty-gritty of repayment terms. We've also explored the consequences of defaulting on your loan, a situation we all want to avoid. But why does all this matter? Because these are the details that can make or break your financial future. Understanding these aspects ensures that you're not caught off guard, and it allows you to make informed decisions. The power of knowledge can help you navigate these financial waters with confidence and make choices that align with your financial goals. Remember, knowledge is power. Use it to make wise financial decisions. Don't forget to like, comment, and subscribe for more financial wisdom. Thank you for watching.